Hey, Steve Saretsky here. As always, this is a Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. This is going to be a little bit of a longer video. I want to touch on some huge movements in the global economy this past week. Obviously, the Federal Reserve coming out and announcing that they would be putting future interest rate movement on hold, future rate hikes on hold. They would also begin to review the quantitative tightening, which is currently running $50 billion worth of assets each month off their balance sheet. Now again, $200 billion, every $200 billion equates to a 0.25% rate hike. So just them rolling off their balance sheet is equivalent to tightening liquidity. And so, this is hugely important for the markets. Now, obviously with the Fed coming out, the markets are anticipating it and saying, wow, great, party on. It looks like interest rate hikes are done. Maybe the next move is probably going to be a cut, party on. But this never changed any of the underlying fundamentals. It's never changed the fact that global growth is slowing. Global growth is contracting. You're in the 10-year of an economic expansion and it's slowing. The fact that the Federal Reserve is putting interest rate hikes on hold only reaffirms that things are broken, as we've been talking about in these videos for a year and a half, 2 years now, is that in 2008, you printed $20 trillion of assets through central banks, inflating the asset prices, and here you are 10 years later, you're stuck at this ultra low interest rate, you can't reduce your balance sheet, and as soon as you do, things start to fall apart, as we're seeing not only through the volatility in financial markets, but China's slowing down. GDP is at just over 6%. You would say, oh, great, 6%. Well, 6% in China is effectively a recession. It's the lowest GDP print they've had in 2 decades. And you have the manufacturing indexes in Europe rolling over, which is essentially a leading indicator of future growth. Italy's officially in a recession. And so, the whole global economy is slowing and is contracting. And that's the main reason why the Federal Reserve is pausing interest rates. I think that just kind of reaffirms where we are in the cycle. And as I talked about before in these videos months ago, the Bank of Canada is done. As I said, they likely wouldn't get to 2%, and they're not going to get to 2%. Market odds right now are not pricing in a single hike from the Bank of Canada this year. The Bank of Canada is not going to try to go against that. And, that's just the reality of the situation that we're in. Now, there's a misconception that, again, because interest rates are on pause, that everything is just going to return to normal and it's back up for asset prices. Again, but totally negating that the whole economy is slowing down. That's the whole reason for it. The only reason the central banks cut rates is because there's a recession. And that seems to be where the global economy is shifting towards. I've already talked about China and Europe, but if we look at Canada, we look at Canada and you have this massive overcapacity in the real estate and construction sector. We've been in a 20-year housing boom, particularly over the last several years. So you have this massive credit and debt buildup into the housing sector with household indebtedness extremely high. And this creates, again, this over-capitalization into the real estate sector, where it makes it ultimately more vulnerable as things begin to turn down. So, any sort of slowdown in credit expansion and any sort of slowdown in home sales and building construction, it's a compound effect. And so, as I've talked about before, you can go back and read Ray Dalio's thing on debt crises, but he illustrates exactly how these all play on itself, right? Like, fewer home sales is going to put developers on hold, and then fewer home sales feeds into consumer spending. So let's just look at some of the recent numbers that have come out of Canada to understand, the impact of this, the knock-on effects, and where we are today. I mean, retail sales fell again. Canada's economy contracted for the second time in the past 3 months. The economy's contracted. So, I mean, that has like a recessionary smell all over it. You have, retail's slowing, particularly in the furnishing and furniture sector. I believe that they fell, GDP in that sector fell 3.5% year over year, which was, I think, the most impacted of that, right? I mean, if people aren't transacting new homes, moving into new places, just staying put, I mean, there's no sense to go out and buy a whole bunch of new furniture to, furnish your home. So the furniture sales start to slow. GDP, residential GDP construction fell 4.3% year over year. I think it was the steepest decline since 2009. And again, so that's because nationally home sales have peaked and they're beginning to roll over, primarily in the single family housing sector, because again, it doesn't really, trying to build a single family home on spec to make a profit today is borderline suicide, at least in Vancouver. Now, multifamily construction is still revving high, and as you can see, we have a record number of units under construction. But again, how is that going to weigh on things here moving forward? There was a recent report that literally just came out today that Toronto new home sales fell to a 20-year low. So, this pulling back this demand. So as soon as the household credit slows down, people don't have the ability to borrow money into the housing sector, sales slow, and this has ripple effects. Your record number of new construction is going to slow. All the jobs that move into that sector, people get laid off, and then that's basically what causes the recession. So it's not the recession that causes the housing slowdown, it's the housing slowdown that causes the recession. So I think that's an important distinction to make. And, I've talked about this numerous times, and I speak with a lot of developers on a weekly basis, and I can't help them for always wanting to be bullish, and I think all the power to them. But I think the whole importance of this channel and the content that I put out is really not so much always about real estate, but it's really just about economics and understanding. I just generally try to portray some information and value, and you can agree with it or disagree with it, but I generally just want to help people navigate and whatever they feel is best. But I think you should be armed with understanding it. So one of the common pushbacks that I get is not only because interest rates are now not going up that everything's going to return to normal, but also that well, let's compare Vancouver to 2008 and to 2012, and I would say, they're saying, well, 2018 was kind of like 2012, and so that means 2019 should be like 2013, which was a pretty good year, like a bounce back. I'm like, well, how are you quantifying that? You have to look at the data, and today, none of the data supports that. If we look at the, true money supply, which is basically the Austrian economics way of quantifying money growth in the economy. And money growth goes hand in hand with the creation of new credit. And what we can see here is Canada's true money supply. It's collapsing. Yes, it's still growing, and it always will grow as the population grows, etc. But even in 2008. True money supply was in 2007 to 2008 was still growing. And so what we can see here is we're in a much different period. True money supply is contracting at a rapid pace. Mortgage credit growth is at a 35-year low. You have OSFI B20 still in, with regulators, policymakers very not interested in removing that barrier. So you're in a much different period. And not only that, but you had, you have more elevated levels of debt. And I would argue that the last couple of years, 2015, 2016 in particular, that boom was facilitated by a credit impulse coming out of China, large capital outflows flowing into Vancouver. And then, because the interest rates were low and the banks were willing to lend and consumers had a desire to borrow, that allowed the typical consumer here to participate. But now you have a situation where, the Chinese economy is clearly slowing. And, they've reduced their purchasing in Vancouver exponentially. I would argue that they're even potentially net sellers, not net buyers. And so, this creates a situation where, we, over the last few years, everyone's just been building luxury homes because there's so much money creation, so much money flooding into the markets. That's just what people were doing. So people were, buying single family lots, bulldozing them, and building these luxury homes to appease a buyer or a demographic that was here in 2015, 2016, but they're not here in 2018, 2019. And so what we have now is basically an oversupply of luxury homes. There's very few people locally that can actually afford $3 or $4 million homes. That's a very specific demographic. And so, when you have a global slowdown, particularly in China, that has a huge impact on Vancouver. So, and it's the same thing for the pre-sale market. That's been a demographically appeasing way to invest money is through the pre-sale market for Chinese in China. And so, as what's happening in their economy is going to matter for the pre-sale sector here. So I think it's ultimately just important to understand where we are and how things are shaping up, and to understand the intricacies and the play-on effects of this. Just because you have a small drop in interest rates, the Canada 5-year bond is plunging. I mean, it's plunged, I don't know, was it now 60, 70 basis points since peaking out. And the banks have only given back 10 basis points on the borrowing side. But the fact of the matter is you can lower interest rates as low as you can drop them to zero. Like, I mean, the Europe ECB has got negative interest rates, and they're still they're on the precipice of a recession, because ultimately, if the banks aren't willing to lend, or there's no desire to borrow the money, it doesn't matter how low the interest rate is. So, again, that's just where we are. It'll be interesting to see how things shape up. Next week, I'll do a video on the Vancouver, market stats. I can tell you, preliminarily that not condos and the detached, both of them, sales for January finished at a 10-year low for Greater Vancouver. And prices continue to decelerate down. But I'll get more into that next week. And, again, that just kind of goes to quantify, because I've certainly had some realtors, telling me, and I've seen it, condos, there's been some condos that have been getting multiple offers, and people are like, whoa, maybe it's picking back up. What's going on? Multiple offers again? But again, if you actually look at the data, I said, well, maybe, but if you look at the data, I mean, we have a 10-year low in home sales. And the inventory is now double what it was last January. And then I look at, the percentage of condos selling over the asking price, and I think it was 8% versus 48% last January. And people say, well, it's still 8%. Well, even in the January of 2009 during the financial crisis, I think it was still 3 or 4%. So you're always going to get things selling over ask. It's if you price it low enough, someone will overpay, right? Or someone will pay more than your asking price. So that's just kind of the situation. I mean, again, I was talking to, another guy in my office, and he's like, yeah, I got multiple offers on this condo in Yaletown, but I also priced it $200,000 less than the last sale. So he's like, yeah, like it sold over ask, but he's like, it was still like 15% lower than the last sale. So I think it's just important to put that in context. That's why I always like top down. You look at the data, and then you can kind of go into the micro things. But anyways, that's all I got. Hope that helped. Otherwise, see you next week.